Apple shares are grinding back this morning despite a cautious note from Loop Capital analysts that sent the shares down up to 172 earlier. Strength across the market continues to follow big tech companies. Let's talk about it with Max Wasserman and our own Tom White here in studio, ready to do some trading. Max is the senior portfolio manager at Miramar Capital. Good to see you, Max. Is still an Apple fan?
I'm still an Apple fan. It's great to see you, Oliver. It's been
Likewise.
a while.
This company is now trading at a one-year high. What about the valuation component? Because a lot of this has basically been a valuation kind of refrothing, has it not?
I believe it has been. I mean, basically the stock is back to where it was in August of 22. So we're not looking like a company that's breaking out multi-highs by 10, 20%. It's just barely hit a new 52-week high. At this multiple, when the stock usually has a 5-year average about 22 times and it's trading at 29 times forward earnings, I think the risk reward is not in your favor on the short term. So to us, our margin of safety is gone right now. We like the company. It's one of our top 5 holdings. But for new purchases, I think it's a little frothy right here, and we'd be looking for a pullback. There's a lot of opportunity here. But again, the company's only growing in the mid-single digits. It's really the buybacks of about $90 billion and the hopes that China will turn around and everything's going to be growing. But the company's richly valued here.
Yeah, that valuation metric, very helpful for us to have in mind. 22x over the 5-year average versus 29 today. With the muted growth that it's got, does that give it a short leash if any of these expectations don't go perfectly? Is this a stock that could trade back down?
Well, again, this is one of the top owned companies out there. It's a 7% weighting in the ETF and the S&P. So anybody buying into these big ETFs are going to pick up the stock. So the underlying demand's there. But we think it's tired. I mean, the stock, how much more do you want this thing to trade at? Over $2, $3, $4 trillion at this growth rate? So to us, I understand India is a big opportunity for them. They're looking for that to grow to like 20, 30 billion over the next decade from a 6 billion now. But again, it's a poor market. It's going to take time to develop. China's 20% of their revenue, and it's a major manufacturing source for them, and they're having shortages issues. So we just think the company's fully valued here. And your risk reward at this level for new buyers, we think, is not as great. Now, that being said, if the market pulled back 7 to 10%, a better risk reward entry point. But right here, we think the company's fully valued, and you're basically chasing, I mean, we believe you're in the 8th inning here. You're basically chasing the last maybe 5 to 10% of the stock with the potential for a farther downside, I think, from here.
Got it. Okay, and you say this is somebody who's held this for a while. I think as long as I've known you, you've had Apple in your portfolio as a big part of it.
Yeah, I mean, we own, we're a very concentrated dividend grower. So it's been, we own about 30 names, and this is about a 4.5% weighting in our portfolio. We're not currently adding a lot of new money to it. A pullback, we would. We've owned it for a long period of time. It's a great company, tons of cash flow that's coming in, and that's what's really supporting the stock, in our opinion. If you can put 90 billion buy your stock back, that's going to do it. But this is not the same Apple of 7, 8 years. Keep in mind, the refresh cycle is 3.5 years now. People are holding those phones a lot longer. So it's going to take them a little while. And again, all we've done is retrench what happened last year. It's not that much higher than it was in August of 22 last year. So if you look at it long term, it's 29 times forward earnings, 22 average. So any hiccup in the market, right, in technology, I think this stock could go a little bit lower. If it did, then a better risk reward, be a better time to go into the stock.
Got it. Okay. Hang tight, because I want to talk to Microsoft. I want to know what you think of all the AI stuff, Max. We got Tom here who's been looking at the Apple options this morning. So I think it's a very nuanced case from a long-time Apple holder here that you don't necessarily need to bail out of this thing, but you should probably be prepared for a little bit of a choppier road ahead. What do you think? How to trade it?
Using the option market, maybe you can give yourself a cushion to the downside, maybe buy it if it does fall. So I looked at a cash secured put here in Apple with the shares up so much and barely down on that downgrade today, where I can sell something out of the money. And this is one of those repetitive type strategies. Well, I looked out to the June monthly cycle, so 25 days till expiration. Just sold the 170 put. You're collecting a credit, almost $2 on that. So that's the most you can profit on that, right? But this type of strategy is twofold. I either want to just keep that option premium I'm selling the put for with the thought that it's going to remain above 170 into expiration over the next 3.5 weeks, or I'm willing to buy the shares at a cheaper price. You can see there from the break even, 168. That's about 3.5% below the current share price in Apple. So you're in essence, if it does fall below 170, you're buying it at a discount. But this is a type of strategy you can use over and over again as long as you pick that strike where you think the stock's going to remain above. But if it does fall, you get to buy the shares at a discount to the current share price.
All right, so collect the premium, and then if it goes down, you want to be an Apple shareholder. Boom.
Right. Right.
You're ready and willing and prepared. Okay, all right, I like it. Max, what do you think about this Microsoft run? Another stock I know that you've liked as a dividend payer as part of your strategy, but then I don't think people are buying it for the dividend lately. I think it's part of this massive new tech AI push that is absorbing all these flows.
It's our number one holding actually right now in our portfolio. And we've been buying it since when they used to have a 3% dividend yield. So we're going back. And we've been active buyers when it broke down into 250s, 260s. Microsoft is trading richly as well. I mean, it's 30 times forward earnings, average 5 years into 27 times. So it's not cheap. It's up over 30% year to date. We like it, but we think there's multiple avenues for them. Azure, their cloud business, is still growing in the mid-20s. It's down from the 40% growth, but still 20. We think that open artificial intelligence, the ChatGPT, will add to the Azure cloud. We like that. They have other avenues as well. The security side of Microsoft is now $20 billion a year for them with a 70% gross margin. So that's a potential for them. I mean, they're hitting you with multiple arrows, if you will. And another one, if they were able to get the Activision, and we all know that's been going on for a while, but if they were, that could add another $10 billion a year. So we think Microsoft has much more potential in the long term, specifically even with the open AI, will add support to their software and cloud business. But again, it's up 30% for the year. So here, we like it a lot. It's our number one position, but we would wait for another pullback before we add it again. We added a lot to it again last year when it broke down. We look for weakness in these high quality companies. Microsoft as a dividend, it's only 1%, but it's still growing 10% of their dividend. Still great, but this is not a major dividend yielder, but it's a great dividend grower. And that to us is a big attraction.
Okay, so that still is the main draw, even if it gets this AI premium kind of pushed into it in the short term.
Yeah, I think a lot of these technology stocks with AI have grabbed a premium. And as you know, 5 technology stocks are accounting for 80% of the S&P's return this year. That's incredible. Everybody's jumping into the AI bandwagon. And as my partner loves to say, AI is in the infancy stage. How do you really evaluate it? But the market's saying it evaluates it at a huge premium so quickly. We think it's going to be a growth engine, but to put these multiples 30 times on a Microsoft, 30 times in an Apple, really you're limiting your upside with this at this moment. Great company, Microsoft. We really like it. We're not backing away from it. But again, we could see you need a pullback on this stock to keep going. These things are running, and all they're doing is recovering what they got hit with last year. So it's really your risk reward when you enter the position. We're holding, but we're not active buyers at these prices.
Okay. All right. Like it, Max. Thanks for the catch up. Always a pleasure to get your thoughts. Good to see you.
Great to see you, Oliver.
All right, likewise. What do you think, Tom? Similar approach to Microsoft? I mean, it is surpassing more important technical levels on its own basis than Apple is, because Microsoft now is within shooting distance of the all-time high. There's no other technical bump on the chart for it to get through.
Yeah, and on a technical basis, you look at the RSI, it's above 70. Yeah, it's overbought on a technical level, but we always know that these things can stay overbought. So I looked at a different type of strategy, whether you're a shareholder like Max is or not, or you think maybe it's going to consolidate, maybe turn around here a little bit. There's quite a bit of option premium in these upside calls. So typically you see that that volatility skew where it comes down as the stock moves higher. But now what you're seeing is a lot of purchasing of calls to the upside in here, that FOMO type of trade. So there's some decent option premium in there. So I looked at a strategy that takes advantage of consolidation or maybe a slight pullback. Went out to that same June monthly cycle, so 25 days till expiration. Selling something just slightly out of the money. The stock has continued to move higher here. Sell the 322.5 strike call, and then buy the 332.5 strike call. You want to stay maybe risk defined on this. $10 wide short, neutral to bearish call vertical here. You're collecting, I've got 340 on here. I think it's trading about 390 now, but if you collect 340, that's the most you can make on it. And you can see here from the risk profile, it takes my break even up to nearly $326. Now that's a couple percent above the current share price. So you're giving yourself a little cushion so Microsoft can continue to grind higher. You just want it to remain below about 326 to the upside on this one. So if you look at the probability of success, that break even is about 60% probability that that break even will be out of the money at expiration. But this might be that strategy where you think it's going to maybe go back down, maybe retrace some of these recent gains, or it can you can use it as a hedge if you are a shareholder selling upside call verticals.
All right, nice, like it. Good way to approach it from the standpoint of someone who owns it.
Yeah.
Thanks, Tom. All right, fitting for Max's position.